No, our base case is 34.50, which represents another solid year. To us, 39.50, if you look at it, we're almost 11 years into this bull market. We've seen a lot of elements conspire to send stocks higher. The one thing we haven't seen is real public enthusiasm, real public buying that you saw at the end of the 1990s, the kind that you saw during the heyday of the housing market in 2005, and every great bull market tends to have that. Our view is that in an environment where interest rates are likely at the long end to move higher, you could see rotation out of bond funds, out of money market funds, where the balances are as high as they've been since the depth of the financial crisis in 2009, and into stocks. That's what moves you there. The other thing we think is important to mention is here we are in 2020. The oldest baby boomer is 75, and the actuarial tables are going to catch up with him or her very shortly, whereas the oldest millennial is 40, entering his or her prime income earning years, prime investing years, and they're underinvested in equities. That's a big trend in our view.
You're also, Loreen, watching demographics, but I want to talk a little bit about your price predictions for the Dow. You think it could hit 30,000 in the first half of this year, correct?
I do. And I think that happens from the strong leaders already, the leaders that we're seeing, like Visa, Microsoft, Apple, continue to do well. Those are the darlings, and it won't come from the problem children like Boeing or Walgreens.
All right, let's ask another question, which is similar. If you think the market is going to go higher, would you be investing more in the domestic U.S. market? Would you be investing more in American stocks, or would you be looking at internationals now?
Well, that's a great question. So we're coming off of a great year in the S&P 500, which also statistically tells us we might have another solid year. It's also an election year, which bodes well for the markets. Having said that, when we look at what's trading at a premium versus what's trading at a discount, we're currently trading somewhat off of a premium on our long-term trends, 20-year trends, whereas international, both developed and emerging markets, are trading at a discount. So there's value there.
So if I'm underweight international now, you'd say your first buy would be international. What's underweight in a general person's portfolio internationally?
So international in general is underweighted in people's portfolios.
But what would be an equal weight? 30% of my equity portfolio would be international?
For a good, 20%. 20%, very few people actually have 20%.
So if I'm below 20%, correct. I would want to add to get to that 20%.
I would agree with that, definitely.
Right.
Julian, are we underweighting the election risks?
Actually, we're not underweighting them. And interestingly enough, the way we measure that is we look at the options market for signs of sort of a relative hedge position. Going out past the election term, the price of downside puts versus upside calls is historically wide. People, despite the fact that we've moved 30-some% from the lows a year ago, people are still very reluctantly embracing the idea that the markets can go higher.
Because we've got, depending on who the Democratic candidate is, and I don't want to make this political, let's keep it CNBC, financial, right? Some of the policy proposals could not be more different. We're talking about potentially ending fracking, ending private health insurance, a tax on every transaction on Wall Street. I'm not saying whether those are good or bad things. It's not a political framework. It's an economic framework. And we're seeing, as we see perhaps Bernie Sanders surge, should investors be willing to accept that there may be a little more risk in the market than there was before? And again, not a political comment, just an economic one based on some of the policies that we see outstanding.
Well, to us, more than Sanders actually surging, what the last several weeks have sort of brought to bear is that the market is implying that it's a two-horse race on the Democratic side, essentially between Biden and Sanders, and the rest of the field seems to be sort of lagging behind. In some ways, that actually reduces the uncertainty, though there was no question that the policies of the two are different. But especially in a place like healthcare, which has been a laggard and is certainly, very cheap relative to the rest of the market, we think the premium is already built in.
Loreen, sectors you love, sectors you loathe.
We love healthcare. And when we look at that, it was lagging quite a bit in 2019 until the fourth quarter when it somewhat caught up. But we still see a lot of opportunity there. Sectors that I would stay away from would be utilities. Trading at a premium, very expensive. There are much better opportunities. People are seeking yield, and they're doing so in a couple different areas: utilities, real estate, high yield debt, right? I would say shift towards quality at this point in your portfolio.
Same quick question to you: a sector you love and a sector you would avoid.
Healthcare and financials we think are going to do very well, and we would avoid the interest rate sector, sensitive sectors, utilities, consumer staples. Over 2% in the long bond yield, which we think we're going to get there in the 10-year yield, changes the psychology.
Julian?